Welcome back to Bazaar. You'd have to say the market is down but not out. The Bank Nifty is the one that's exerting maximum pressure, down about 1%. But the earnings season is just around the corner, so let's get you our special segment, Quarter Se Quarter Tak. We kickstart with the IT earnings that will begin next week. Reema's here to tell us what to expect. Reema.
Thanks so much for that. So even as the sector battles with worry of slowing revenue and margin uncertainty amidst the global macro deterioration, this quarter's revenue growth is expected to be steady and strong, about 3 to 4.5% revenue growth in constant currency, which is led by the strong order intake momentum seen in the prior quarters. So amongst the large cap, according to the CNBC-TV18 poll, it's Infosys which is likely to report the highest growth at 4.6% in constant currency revenue term. But as you can see over here, there is a big difference in the constant currency revenue growth and the dollar revenue growth. The constant currency revenue growth is almost 200 to 300 basis points higher than the dollar revenue growth. And that is on account of the large currency moves that we've seen in the current quarter. So while the INR depreciation on an average is about 3.5%, and it's a big positive for the Indian IT companies, look at the way the other currencies are depreciated versus the dollar, the euro, pound, Australian dollar, yen, the Canadian dollar, and this will limit the dollar revenue growth, something that we call the cross currency. So that explains why the constant currency revenue growth is expected to be higher than the dollar revenue growth. That said, the net impact of the currency moves is positive on the margins, and this is one of the factors which will drive a quarter-on-quarter improvement in margins. So let's get that poll up for you on your screen. So the highest increase is seen for TCS, where the increase on a quarter-on-quarter basis is seen at 70 basis points. But for the rest of the IT companies, the margin benefit or the margin gain is fairly limited, and that is due to the residual impact of wage hikes. So Infy this quarter gave hikes to its mid and senior employees. Wipro's wage hikes were effective 1st September, so there was a 1-month impact on the margins, while HCL Technology will also be impacted by the full quarter impact of wage hikes, which is why quarter-on-quarter there is a margin improvement, but fairly limited. Now let's move on to the FY23 guidance. Now both Infy and HCL Tech are likely to retain their annual FY23 revenue and margin guidance. So for Infy, 14 to 16% constant currency revenue growth and margins at the lower end of 21 to 23%. For HCL Tech, revenue guidance stays at 12 to 14%, while margins again will be at the lower end of the 18 to 20% band. But the key is not going to be in the numbers, it's going to be in the commentary. So far, the management commentary by the Indian IT companies has been positive in Q1 and even post Q1 in the run-up to the Q2 earnings. But most macro indicators in the developed market have been deteriorating. So the question is, will the positive management commentary hold up, or are we going to see signs of a slowdown? And in that, to assess signs of a slowdown, watch for two lead indicators of growth. One is hiring and the other one is deal wins. Both of these indicators were muted in Q1. And if you get another subpar reading on deal wins, new deal wins and hiring, this will support the bear argument on IT stocks. In terms of geographies and verticals, the affected geography is UK and Europe. So commentary on UK and Europe will be important. And also, developments surrounding Credit Suisse is going to put the spotlight on BFSI. So watch for BFSI very closely. And finally, retail as well, because the high inflation is hurting retail companies globally. Another question that we will be asking the management is, what about the price increases? Are customers still open to conversations surrounding price increases, or are they pushing back? And finally, as the pressures on profitability continue to mount for the IT companies, will the industry go slow on hiring? Will they resort to salary cuts or lower variable costs? Remember, in this quarter, there have been ample reports about how IT companies have given lower variable bonuses to their employees. In a nutshell, the commentary which can give you a sense of FY24 revenue and margins will be crucial. Now, the sector has already very sharply derated. This is what the COVID valuations used to look like, 30x for TCS. It's already come down by 20-25% from peak levels across the board for IT companies. But most of it is on account of a PE reset. The earnings downgrade have been fairly limited to low, mid-single digit kind. The worry is that if the slowdown accentuates, will the earnings hold up, or will we see EPS cuts? Back to you.
All right, Reema, thank you very much. Very nicely explained and very exhaustive as well. Manik Taneja is joining us, IT Services Research Analyst at JM Financial. Manik, good to have you with us here. Thank you very much. Big picture, will we get some relief, or will troubles and commentary point southward once again. What's your sense?
Thank you for having me on the show. So what we've continued to hear from companies through the course of last 6 to 7 months is that they have remained fairly confident around demand trends, while companies have had certain margin pressures to essentially deal with. I think with the upcoming quarter and given the fact that over the course of last 3 months, we've continued to see deteriorating macro news flow, I guess we will hear some amount of caution emerging from company commentary. Over the course of last 3 months, some companies have been talking about client-specific challenges emerging, and even have been talking about uh, some sort of extended furloughs in December quarter, unlike the strength that one has seen in the last couple of years. So from that standpoint, the commentary may be a little bit negative. However, I'll also add that when you look at the commentary that one has been picking up from the global peers, and I'm talking about the likes of Accenture, Capgemini, EPAMs, Endavas of the world, most of these companies continue to suggest that the growth trajectory is sustaining above the pre-COVID levels. And in fact, surprisingly, while Indian IT companies have seen margins deteriorate, and today margins for tier one techs are running below pre-COVID levels, and Accenture improved margins last year and is talking about further improvement in margins. So global companies continue to remain much more resilient and benefiting from price increases. So from that standpoint, the commentary that we get from Indian companies as to what is the way forward will be very important.
Okay, let's take it one by one, right? Manik, what is the expectation particularly from TCS? The reason I ask is because TCS has a fairly large exposure to Europe and UK. About 30% of their revenues comes from there, and there's margin pressure expected as well. What is your own thought, and how would you approach the stock now ahead of the earnings?
Sure. So we've had a hold rating on TCS, and in case of TCS, we've seen that TCS has underperformed peers like Infosys on growth through the course of last 3 years, and I think that story will stay intact even through the next few quarters. Certainly, with their higher exposure to Europe and UK, and which is basically both translating into significant cross currency headwinds on reported dollar terms, and also translating into margin headwinds given the fact that INR is appreciated against GBP and Euro. So from that standpoint, TCS is expected to have a relatively weak uh, revenue growth performance as compared to somebody like Infosys. Uh, in terms of so what we will be looking for when TCS reports is what do they suggest on the order booking numbers, and how are they seeing their large European customers essentially behave in terms of spending trends going forward.
Okay, hi Manik. I was just looking at the chart that Rima put up, and HCL Tech has always traded a bit of a discount in comparison to its larger peers. But, doesn't it make it a bit of a compelling argument on the buy side? What's your view? HCL Tech, Tech Mahindra, they're trading even at a discount in comparison to the last couple of years' averages. What's your view?
Sure. So certainly, if one looks at the current valuation multiples relative to pre-COVID multiples, the premium for an HCL Tech or Tech Mahindra may be much lesser as compared to an Infosys or a TCS there. Now, both these companies have their own set of challenges. Tech Mahindra, the name that you mentioned, their margins are already back to an 11% levels. So that's a company which typically tends to improve margins to about 15%, closer to 15% in the span of 2 years, and then takes 2 quarters to get back to 11% levels. So that's the volatility that is associated with Tech Mahindra. In case of HCL Tech, their services business has kept on doing quite well, but the product business has had a very tepid revenue growth, and there are concerns around the sustainability of the product business. And even HCL Tech has compromised on margins over the course of last 12 months. That said, in case of HCL Tech, what we are enthused with is the way they have been doing well in terms of order bookings over the last 12 to 18 months time frame, and the fact that now their growth mix essentially is far more balanced as compared to infra-driven growth for them in the past.
Okay, just one final question then. Do you expect both Infosys and HCL Tech to retain their growth outlook for FY23, or do you think that some of these companies may scale it down as well, given the challenges?
So, given the way arithmetics is, I see very little risk to Infosys pulling down their revenue growth guidance. Probably the arithmetics is slightly more tougher for HCL Tech from a relative standpoint. In terms of margins, both these companies after 1Q itself guided for margins to trend closer to the lower end. And I would presume that they will probably stick to that outlook even with this quarter's results.
All right, Manik, thanks very